What's up, everybody? Thanks for tuning in again to the Stock Market Plan, Stock Market Watch. This is the April 24th, 2020 edition. Last time we did a cast here was back on Monday. Today's Friday. Going to go ahead and recap the week. We talked about this market settling down some, possibly this week, as volume started to trend lower, right? We drew this line back on Monday, and sure enough, there it is. Right, here's the volume for today and the rest of the week. Stayed under that trend line, really calming down. So here's the volatility index. It measures the, for lack of a better term, the level of risk in the market. And it's been really calming down here since, the better part of, since March 9th here. You can see now this is today. It's at the lowest level it's been since. So it's a secondary indicator, but investors use it, traders use it to gauge the level of risk in the market. Again, secondary indicator. I've told you before that we pay attention to price here the most. The price and volume are pretty much going to dictate a lot of the different indicators that you use. And man, there are just hundreds of them. MACD, stochastics. There's just so much stuff that you can use. But I like to use the raw data, right? Why do I need to do all of that when all of those algorithms and programs and all that, guess where they come from? They come from time, price, and volume. And that's what we're going to look at right now. We're back here to the SPY representing the movement in the S&P 500, the broader market, right? We drew this trend line on Monday. Also made note again, this resistance level here that's very thick, all right? Very thick. The market bumping its head, right, all of last week and this week. I spoke about the market squeezing here into this area. And the great thing right now that's happening is that these moving averages, this blue line here being the 50-day moving average, and this one's going to move a little bit slower. This purple line is the 200-day moving average. Both critical indicators. Markets tend to do well when they trade above these averages, all right? And also stocks, and basically anything. When you're using the 50-day and the 200, it's a quick way of gauging the health of a chart on just about anything. So, here we are, the price here today, right? Guess what? We closed over the 50 today. And I told you that this 50-day here, it was a good probability that it would come down as this market settled down, and sure enough, it has, right? And now the price trading above it. So I see this market now, unless there's some kind of news that comes out or something, I would love for this thing just to do this right now and just trade sideways here. All right? Volume calm down still. You can see the volume has just steadily decreased. Things are settling down. The market's trying to figure it out here going on right now. And it's a market that it is in a consolidation phase. I spoke about that. And there it is, just consolidating, right? It was the start of something. Did not know what was going to happen, but we had a probability, right, of this market moving sideways. And sure enough, here we go. So far, it's not about being that I was right or wrong. It's just, as a market, I always said, the market has to give us more data, and it's starting to do that now, okay? We have this market now trending sideways. How long it lasts, I don't know. But when you're looking at stock investing, right, and you're thinking, and these studies are particularly for people who want to get involved in individual stocks. In some way, you can make the case that, if you're investing in any type of stock instrument, like a mutual fund, a growth fund, or a value fund, they're going to be invested in stocks. They're going to be invested in this, right? In the overall market, for the most part. And what's going to happen, it really doesn't matter what they're invested in, right? Emerging markets, domestic, it doesn't really matter. International, they're going to be pretty much going to move to the tune of the overall market. And I can sit here right now and start pulling charts of mutual funds, and they will look exactly like this, especially if they have a large exposure in stock, in equity, okay? They're going to look exactly like this. Why? You guys already know. I'm going to drive it home. 3 out of 4 stocks are going to move in the direction of this. So important, guys. So important. You got to know this. It is probably the single most valuable lesson that was given to me probably about 20 years ago. It is held so true. And it's a good thing to know, because if I'm looking at this market right now and I'm thinking to myself, okay, I want to get involved in stocks. Well, very few things are working out there right now, and you have to be really good to get a decent move out of a stock. After all, we invest in stocks to get appreciation. Some people like to invest in stocks because of dividends and this and that, and I get that. I'm not a big fan of dividends. The reason being is because dividends could be a false hope sometimes. You know, oh, I'm getting a hefty dividend of 8%. Yeah, but your stock's down 30. Do the math, right? I just found it better to invest on the stocks that are poised to go higher fundamentally, right? Their balance sheet is very healthy. I've talked to you about this before, 25% increase year over year, quarter over quarter, both in earnings and sales. As far as the fundamentals are concerned, that's pretty much I'm going to look at. Because again, you've heard me say this before, sales never lie, all right? I don't care what you do for a living, if it's a service or a product. If you have sales, you're pretty much going to do okay, unless you have like a stupid board or a stupid, which actually doesn't even make sense, because it would be the board that's making the prudent decisions that are driving those sales, right? But I mean, it's very consistent when you have a company that is, because remember, fundamentals, the balance sheet, we're looking at past performance, right? But when we look at price, what we're looking at right here in front of us, you know, this is a forward-looking mechanism for stock. Okay, for a company. Why? Because it is a price, it is the value, it is the implied value of a company. It is the forward-looking mechanism that says, you know what, we think this is worth this going forward, right? So fundamentals are good to have. They show strength, right? Because your probability of doing good in the stock market is much better in a stock that has done well in the past. Therefore, more than likely, it'll do good in the future, right? So again, the big word is the P word, probability. I mean, what is the probability? That is all we are working with here. And as the market gives us data, we make investment decisions based on that. No there's this, I don't even know if I like to use the word speculation, to be honest. The speculation sounds almost like a guess, like a wild guess. I like to think of this business, when you're looking at it this way, as a science, where you're seeing different things and you're adjusting, you're managing the risk based on the data that you're receiving day to day. So we're looking at this thing right now, trading sideways, has this big ceiling on top here, right? And again, going back to my earlier comment of, we invest in markets to make money. We invest in markets to see stock price go up, right? If you don't think that is the case, then I don't know. I mean, so that's why we do this, right? We do this to make money, position ourselves in a way that we have the best chance of making money. So when I look at this chart, and I look at the ceiling on top of me right now, right? The overall market, 3 or 4 stocks move in the general direction of this. You know, how do you like your chances, right? You got to look at this. You got to ask yourself that. And if I am looking at an individual stock that I want to invest in, and we'll get into this more as we go forward, you know, I really want to drive this here, this overall market health, really drive it into you. So you got to start here. You have to start here because of reasons that I've just mentioned, and I'll keep driving it home. So you sit here and you're looking at an individual stock. You get the story, you get the pamphlet in the mail, blah, blah, blah. But they do this, they do that, you know. And it might be a good stock. It might be a decent stock. It might be a bad stock. It doesn't really matter, because this that you're looking in front of you is going to provide either a tailwind to help you, or B, a headwind to hinder you. So if it's a stock that I'm looking, you know, when you invest in stocks, trade location is something that we're going to get into eventually, and we're probably going to look at certain charts of stocks here soon and start looking at certain trade locations and what goes into selecting stock. We'll look at the chart, we'll do some exercises, we'll start looking at charts of stocks, and we'll say, well, here's what it looks like here. I see these levels here. And you got to start asking yourself, what do I want out of the stock, right? Because you can't hold it forever. I mean, we've seen where that's gotten you, right? Hello, right? So, we got to look at it in the way that says, and it's funny because any venture capitalist or good business owner knows well that the ultimate goal of that business owner is to sell that business at a premium, right? You want to buy the business, you want to develop the business, whether it's an existing business that you're going out there and acquiring. You want to make that business better so you can hope to sell it at a premium, right? We want to go ahead and then maybe get involved in another venture. But your ultimate goal should always be, let's make money as quickly as possible and move on to the next instrument. Well, the stock market is a lot the same way. We use stocks. These things are made to be traded. They're not made to be. I mean, you can buy and hold certain things, but where does buy and hold get you when you run into something like this? And we look at this thing now, and in hindsight, we're like, oh, well, we're halfway back already. Well, I also spoke about this. I said way back here that, probably around here somewhere, that this was probably because of things that are in place in this economy we haven't seen in quite some time. I've talked about 2008. I've talked about 2000, right? Two of the biggest corrections that we had before this one. Well, in this correction, there's something present in the backdrop that was not present in those times. That being a healthy economy, historic record economy at so many levels, right? So that was not in place in 2008. There was no place to even go. Everything was down. The unemployment numbers were ridiculous, super high. Wages were super low. There was no wages growth. GDP was garbage. I mean, there's just the economic makeup of those times were not what you have today. And I like to say that outside of this virus, it's going to be something to watch this thing come back. And I spoke about this. I said all of that I'm telling you right now. I said it way down here when we were down ridiculously, right? And I didn't know this was going to happen. This confirmed upturn that we're in right now, because it is a confirmed upturn. We also drew this line on Monday, right? And here we are. So it's there's things in the background here working that are still in place. They have not gone away. It's not like we've got a whole nother makeup now to the strategy, to this economy. The trade deals, all of the things that have happened that made, this ridiculousness, right, happen before this virus took over. I mean, this is a massive, massive, massive climb, and I spoke about this before in previous videos. Before this happened, right, before this massive drop happened because of the virus. The beginning part of it was a correction that needed to happen. Why? Because we had gotten so far away from the averages. Here's the 50, the 200. We just went parabolic. We just went up like a tower. So the market always has to come back to the mean. How much time it takes has to come back to the average. How much time it takes, I don't know, but it does. That's what markets do, right? They never go straight up. And in the last 14 months prior to this drop, right, if we go back 14 months, the markets were up. The S&P was up in excess of 40%. That's like 4 years, average of 4 years gain, right? Historically speaking, 3 to 4 year gain. We did that in 14 months, okay? The NASDAQ was up over 50%. Over 50% in 14 months. So historic by so many measures. It was ridiculous. And all we were hoping for, everything that we were hoping for, was that this market would come down to these averages and then build and go up again. Well, it started to do that, and then right around here, late February, we get the news of the virus, we get a blip, and then we just crash. And this is not something that you can plan, right? And I always made the analogy. This is like two planes hitting a building in New York. You can't plan for that, and it's not rational, right? But it does happen. Events happen. But before that, you had this market that was just awesome. It was amazing, and the things that made this happen, this you know, being up 40-50% in 14 months, it's just a little bit over a year, they're still in place. So going back to my earlier comment of this market, I always, down here, well, we're at the lows I was mentioning this, that what I didn't want to see is this market just go straight up in a wedge. And guess what it did? Exactly right. It did that. And I was waiting for this, and we're getting it. We're getting now calming down. Volume is calming down. I would love for this thing to build a base here now and go higher from here. I am currently right now 25% in stock, 75% in cash. That is the way that I'm allocated right now. That is what I see this market, the risk level is there, because the market could start coming down, right? And because of this resistance. And if it does, then I'm going to be paying close attention. Look at this, what is this, Friday, Thursday. Look at this market just bounced right off of that trend line. This is why we do this. Look at this thing. Boom, right? Well, trend line, it just sat there, bounced off of there. So it can do that. It can go here. Maybe it'll go to this one. Even if it goes to this one, I think the market will be fine. In all of this space right here, the market would be fine, right? I would probably still be 25%, and I'll probably still be holding a 25% equity position of my portfolio, right? It really doesn't start getting into trouble until you start breaking, and we have to pay attention to volume, what kind of volume comes in when it breaks these levels, right? That's important too. Is it the big money players dumping stock, or is it just people, the individual investor panicking, because we got to pay attention to the big players. They're the ones that move markets. It's not you and I, right? We got to pay attention to the big players because those are the guys that are going to move markets, and we just want to get on their coattails and ride it. They're moving hundreds of thousands of shares of a stock in a week or two. And those are the and you can see that. You can see that in the timing sales. You can see the prints coming in on the tape. You can see what's called block trades. You can see, 10,000, 20,000 shares. And you can see that on the tape in an intraday basis. So now we're not seeing that because the volume is calming down, right? There's a volume just deteriorating. So now the market's trying to figure it out up here at this level. It's going to trade sideways. So, that's where we're at. I mean, it's research time right now. I'm looking for opportunities. I'm looking for stocks that show good fundamentals and that show good chart patterns, right? The price, and that are poised to be the new leaders to go higher. So when this base finally works itself out, whether it does it up here or it comes down a little bit here and it builds and then it finally breaks through, then I'll be adding more position to stock. But for right now, 25% is all I'm willing to take. That's the risk I'm willing to take simply because of the resistance level that we just keep banging into right now. All right. So I think this thing's going to trade sideways, and we'll just see where it goes from there. I'm going to be looking at some stocks over the weekend, but I always start here. What is the overall market doing? So important. Do I have a headwind? Do I have a tailwind? So important. 3 out of 4 stocks are moving in the general direction of the market, right? I'm going to say that until you throw up because it's that important. It is that important. So, guys, thanks for tuning in. Post some questions in the comments below. Make sure you subscribe. I don't think you can post comments unless you subscribe, and you should do that anyway. So this way, when I post videos, you can get an alert and look at the video. So go ahead and subscribe to the channel. Really appreciate it. So next week we should be getting into some stocks, and we'll go from there. We'll start looking at these charts, and it's basically going to be the same thing, right? We're going to be looking at resistance levels. I'm going to show you what I do to draw all of these lines, how I came up with this resistance level here, right? This is something that I drew, many price levels that I drew from way on back. I mean, some of them are over a year old, but this is what happens. Usually the market doesn't forget within a year, and this is what you get. If you didn't have this, you'd just be out there willy-nilly, like whatever, you know? Oh, great product, great service, invest in it. Well, that's sometimes true, but you know, you got to really pay attention to price, volume, and time. So important, so important. All right, guys, that's what we got for you today. Make sure you subscribe, comment, share. Okay, really appreciate it. Share it with your friends. We're gonna learn something together here for sure. All right, we'll see you on the next one.